Well, good morning, everyone. I hope that you're ready for our last little session on cafeteria plans. Just a quick review of the FSA topic that we started yesterday. Cafeteria plans can offer another type of benefit program known as a flexible spending arrangement, or FSA. FSAs give employees the opportunity to pay certain covered healthcare expenses and dependent care expenses with pre-tax dollars through salary reduction. The maximum salary reduction for 2020 is $2,750. While most plans are a use it or lose it plan, some do offer a grace period of 2.5 months after the plan year end, in which those unused balances can be used and receipts turned in. Others offer a $500 carryover limit, which quite literally means that $500 of your balance can carry over into the new year for expenses. Without that carryover or grace period being firmly written into that plan, employee balances are then forfeited. That's the main difference between an FSA or an HSA, a healthcare expense reimbursement. HSA just keeps accumulating. You can keep that money in there and then eventually even use that to pay for any Medicare premiums once you retire. Where the flexible spending account, those monies do get forfeited most often. So we'll start this first slide with our uniform coverage throughout the coverage period. The maximum amount selected by a participating employee and which would be their total payment for the entire year, must be available to an employee all times during the year. The amount available is reduced each time an employee submits a claim for reimbursement. But if an employee elects to have $2,750 in their plan year, say they fill out those forms in December for a 1/1 effective date, and January 2nd, they submit a receipt to you for $2,750, they can use that entire amount, even though they have not yet contributed that full balance. It truly does not matter how much the employee has contributed to that FSA when the claim is made. So referring to this example, employee Ralph selects coverage under a healthcare FSA requiring premium payments of $1,200 and monthly salary reductions of $100. By March, Ralph has contributed $300 in premiums. If he submits a medical expense claim for $1,000 in March, he must be reimbursed for that entire amount. The employer cannot accelerate Ralph's salary reductions to make up the difference either. So, certain elements there to keep in mind. There are special rules for dependent care FSAs as well. Dependent care FSAs are not subject to that uniform coverage rule requiring a maximum amount to be available at all times. It's important to note that dependent care assistance FSA may not reimburse employees for expenses other than that dependent care. So it's not, even other options referring to those dependents. It is strictly for that daycare or type thing. The 12-month period of coverage. Generally, a healthcare FSA must provide coverage for a period of at least 12 months with limited exceptions. Those exceptions would be things like a short first plan year or new employees who, are coming in with that mid-year. Employees cannot change or revoke elections made before the plan year unless they have undergone a change in status that would allow an election change or revocation in general under a cafeteria plan, like those items we went over yesterday. Prohibited reimbursements. Healthcare FSAs can only reimburse for qualified medical expenses incurred during a plan year. So when you think about that, and we have another slide that's going to give you a few more items that are covered, but in the fall, typically, you'll see commercials that will remind people to use their flexible spending accounts. There'll be even over-the-counter medications that would be qualified. Dietary supplements are not, or even your vitamin supplements are not considered qualified, but a lot of over-the-counter medications and first aid items can be turned in for an FSA reimbursement. Claim substantiation. Medical expenses may be reimbursed only if the employee provides substantiation from an independent third party, like a doctor or hospital, stating that the amount incurred is qualified. So looking at that receipt, the employee can state the expense has not yet been reimbursed and is not reimbursable under any other health coverage. Or item 3, if the expense is an over-the-counter medicine, but prescribed from a licensed physician. Substantiation may be electronic, and you can pay that through that electronic debit card, meeting the IRS requirements for those qualified expenses. The claims incurred. Reimbursement can be made only for medical expenses actually incurred during the period of coverage, including a grace period, if that is written into the plan. Medical expenses are incurred when the medical care is provided, not when the employee is billed or when they pay for the care. Reimbursements of future or anticipated expenses cannot be made. Flexible spending account experience gains or forfeitures. This means, in easier terms, the forfeiture of employee balances under a use it or lose it rule. What do you do with them? With respect to the plan year, plus a grace period, if any, this equals the amount of the employer contributions, including salary reduction contributions and after-tax employee contributions to the federal or flexible spending arrangement, minus any total claim reimbursements for the year. Experience gains or forfeitures may be retained for the employer for maintaining the cafeteria plan. They can be used to reduce required salary reduction amounts for the immediately following plan year on a reasonable and uniform basis or equal basis, or used to defray expenses to administer the plan. If not retained by the employer or used to defray expenses of administering the plan, the experience gains must be allocated among the employees on a reasonable and uniform basis. So you're going to spread out that balance remaining. It is permissible to allocate these amounts based on the different coverage levels of employees under the FSA, such as a single or family. Experience gains allocated in compliance with these requirements are not deferral of compensation. However, in no case may the experience gains be allocated among employees based directly or indirectly on their individual claims experience. Experience gains may not be used as contributions directly or indirectly to any deferred compensation benefit plan. So once an FSA, always an FSA. If you're going to spread that money out, if anything is left, it gets spread out equally, regardless of their past claim history, regardless of their status, whether it be full-time or part-time. The only difference you can make or differentiation that you can make is if they are a single or family plan. Your first pop quiz. An employee uses cafeteria benefits of $350 per month to pay for chosen benefits. The 350 represents what? Non-taxable compensation, taxable, which is it? Perfect, looks like everybody replied. So it is a non-taxable compensation as long as it's not chosen as a cash benefit. Under Section 125 Cafeteria Plan rules, the use of contributions to purchase eligible benefits is non-taxable. So guess what? This is the end of the Cafeteria Plan module. And since this section was not real thick, not very heavy for comprehension even, we didn't have to stop a lot, we didn't have a lot of questions. We're going to get a jump on things for Melissa for next week. So we're going to start Module 7, which is payroll reporting and employment taxes. The first part of this is our tax deposit requirements. The payment of withheld federal income, Social Security, and Medicare taxes, as well as the employer's share of Social Security, Medicare, and FUTA tax, is handled a bit differently than other taxes. Rather than paying the taxes when you file the return, employers generally must deposit the taxes using Electronic Federal Tax Payment System, EFTPS, or in a very limited situation with a check and a tax return. It's very, very limited. This section is going to explain the rules governing the timing of employer tax deposits. I'll give you a couple little hints as we get started. Look back period is crucial to know. EFTPS, you need to know what it is and how it's used. Your timing of deposits, whether they're a monthly, weekly filer, those types of things. So just a few little heads up things to kind of keep watch of. So the look back period, to determine the frequency of payroll tax deposits, the IRS uses a 12-month period called the look back period. In our depositor classifications, employers are assigned one of two depositor classifications, monthly or semi-weekly. That determination is based on the amount of employer total liability for federal income withholding, Social Security, and Medicare, which is considered employment taxes or federal taxes. During a look-back period that generally looks back over a 12-month period. That look-back period is the 12-month period from July 1st of the second previous year through June 30 of the previous year. If an employer's 4 quarterly 941s during the look-back period show a total federal income withholding, Social Security, and Medicare tax liability of $50,000 or less, the employer is a monthly depositor for the upcoming year. If the total liability exceeds $50,000, the employer is then a semi-weekly depositor. Each employer's tax deposit frequency is based on the tax liability in the look-back period, as we just discussed. Monthly depositors must deposit their accumulated tax liability for each calendar month by the 15th of the following month. I'm slowing down a little bit on this because I know for a fact these particular definitions were on my exam for CPP. Semi-weekly depositors must deposit employment taxes for wages paid on a Wednesday, Thursday, and Friday by the following Wednesday. Employment taxes for wages paid on Saturday, Sunday, Monday, and Tuesday must be deposited by the following Friday. Hopefully that makes sense. So they're talking about when does the employee have cash in hand and when then the employer needs to submit those employment taxes. It's important to note that if an employer's accumulated employment tax liability reaches 100,000 on any day during a monthly or semi-weekly deposit period, the taxes must be deposited by the close of the next business day. There's an annual deposit rule. This is assigned to employers filing on a 944 instead of 941, with a filing history showing less than 1,000 or in employment liability taxes each year. The quarter de minimis deposit rule refers to employers with accumulated tax liability of less than $2,500 for a quarter. They can deposit the next quarter liability according to their monthly or semi-weekly depositor status, or pay it with their 941 return. This safe harbor rule also applies if an employer's employment tax liability was less than $2,500 for the immediately preceding quarter. That's a lot of words to explain these. And I think these examples, we have 2 slides with examples, and I'm going to give you a couple of seconds to kind of read through them. Again, as I said, they're going to be very important to know the difference when you take your CPP. Also note, let's just read one of the examples. Semi-weekly depositor Nuts and Bolts, Inc. pays wages on Friday, June 5th, 2020, with an employment tax liability of $54,800. They have until Wednesday, June 10th, to pay that liability. The reason I wanted to read that is when I took the CPP, they referred to federal tax often. It looks like everything I'm seeing now, if they're wanting to include Social Security and Medicare in any calculation, they're going to be using the phrasing of employment tax. Otherwise, they'll just tell you federal income tax.
And I did debate whether or not to include all of these examples in here, but Rebecca had been stressing how important it is to practice the comprehension, and these examples really help walk you through that. So they're more included in here as a reference for when you're studying to go into that test. So these slides, hopefully you have printed copies of them, or I have been emailing them out. So just before your test, you can review all of the examples. That's why I've been including examples in the slides in general.
I think it's great to include them, Manon, and I'm certainly not going to spend a ton of time. I just wanted to make sure that, you know, all the words that I just said, you had the opportunity to read through an example and go, oh, that's what that means. So. Okay, so let's talk about shortfall. What happens when you cannot make that tax liability payment? The IRS allows a safe harbor shortfall, so employers are not penalized for depositing a small amount rather than the entire amount of their deposit obligation. Penalties won't be applied for depositing less than 100% of the amount if the following conditions are met. The shortfall cannot exceed the greater of $100 or 2% of the amount of taxes that were otherwise due. The deposit shortfall must be paid or deposited by the shortfall makeup date. For example, for a deposit up to $5,000, employers are still in compliance if their deposit shortfall is no more than $100. For deposits of more than $5,000, the shortfall can be of no more than 2% of the amount due. For monthly depositors, the amount of the shortfall must be deposited or remitted by the due date of the quarterly return for the quarter in which that tax liability was incurred. Semi-weekly depositor shortfall can be deposited by the first Wednesday or Friday, whichever comes first, occurring on or after the 15th of the month following, or by the due date of their quarterly return. Note, semi-weekly depositors may not remit payment with their quarterly 941. It must be deposited through that EFTPS system. Agricultural employers and railroad retirement taxes. Those are both filed on annual employment tax returns rather than quarterly. For this reason, they have a different look-back period than other employers. Their look-back period is the second calendar year preceding the year for which the depositor status is being made. Example, calendar year 2018 is the look-back period for determining a depositor status for 2020. Agricultural employers are subject to further complications if they have both farm and non-farm employees and therefore have to file both 943 and 941. Their depositor status for 941 is determined separately with a different look-back period than that of their 943 employees. Manual or off-cycle checks. Employers incur deposit liability when the constructive payment has occurred. If the employer is a semi-weekly depositor and that off-cycle or manual checks is paid on Tuesday, the deposit of the withheld employer taxes must be made by Friday. So we're going to try to do some calculation with not math. We're just going to read through these calculations on how to calculate your total federal tax deposit. The total tax liability consists of the following: the federal income tax withheld from the employee's wages paid by the employer, the Social Security tax withheld from the employee's wage paid by the employer, the Medicare tax withheld from the employee's wages, again, paid by the employer, and then the employer's share of both the Social Security and Medicare tax. That's what makes up your actual full tax liability. I'm sure that's fairly basic knowledge. Your tax deposit methods. We touched on this briefly a few minutes ago, talking about the EFTPS system. The only time an employer can pay taxes with a check is when the taxes are paid under certain conditions, like when filing a 943, 945. Sometimes it's allowed with a 941 or 940. You must know those rules. In all other situations, employment taxes must be deposited using EFTPS. The electronic federal tax payment system. This is the platform which tax deposits are processed through the Automated Clearinghouse or ACH system. This is also used to The same ACH system is also used to make your employee direct deposits for their wages. ACH is a funds transfer system that provides the clearing of electronic entries from participating financial institutions. Your main payment options for employers using EFTPS are EFTPS Direct, which is an ACH debit entry, and EFTPS through a financial institution or ACH credit entry. The EFTPS Direct is a transaction in which EFTPS, after receiving instructions from the employer, instructs an employer's financial institution to withdraw funds from the employer's account for a federal tax deposit, and then routes that deposit to the appropriate treasury account through the ACH system. If an employer wants to make a tax deposit using EFTPS Direct, it must contact EFTPS by 8 p.m. Eastern Standard Time of the last business day before the deposit due date and provide its EIN and PIN number. After the ACH debit entry is initiated, EFTPS will validate the payment information and issue an acknowledgement number to that employer. EFTPS through a financial institution is where the taxpayer or employer instructs the financial institution to originate a federal tax deposit through the ACH system to the appropriate treasury account. Employers wishing to use this payment method must verify they use a financial institution capable of originating such entry. To ensure it is initiated in time to properly credit the treasury account, the employer must take into account its financial institution's deadline for originating entries like this. Typically, that EFTPS Direct is going to be the best method because then Treasury automatically has that money versus waiting for your ACH, where you would have to typically wait a day or two before then that bank would submit the funds. Federal Tax Collection Service, or FTCS, is a same-day deposit through FedWire. Employers would use their same-day taxpayer worksheet that's available on the EFTPS website and would also have to make arrangements with their financial institution. And of course, refunds and reversals are not going to be processed like deposits, and they're certainly not going to be made very easy for employers. You would have to file a 941X or call the IRS for assistance. The next slide just refers to federal tax forms that are going to be really important for you to know. While most people automatically, we all know what a W-4 or W-2, a 940 and a 941, we all have a basic knowledge of that, even pretty much regardless of your payroll knowledge. If you're taking this course and you're going to be taking the CPP or FCP, you're going to have a basic understanding of those forms. However, many of these other forms are also on the exam and you would need to know their use, such as the SS4, the SS5. Both of those I did see on the exam. You're also going to need to know certain other systems besides EFTPS, and those are things that Melissa will get more into next week for the different systems. And another federal tax forms continued. I'm not saying you'd have to, memorize each form and their use, but you're going to want to know, okay, if I'm going to give my non-employee, my independent contractor, that's the phrase I was trying to think through, a 1099 NEC for non-employee compensation, I need to know what form that is, the name of the form, what it does, and then how do I submit it to the IRS. what system do I use? So basic things that you do need to know. So let's talk about some calculations. This is a full-on calculation going through the worksheet of how do I write, go through all these methods. This particular one is using the optional flat rate method of 22% to calculate federal income tax withholding on commissions, bonuses, awards, prizes, fringe benefits, etc., etc.
Should we take a few minutes and fill out this worksheet?
I think so.
And I think in this example that was provided by PayTrain, they had you calculate all of this on an annual basis rather than on the semi-monthly. So that single person, that percentage method table is, yeah, the annual pay period.
Okay. I was just going to say, does this help that I switch to the next slide for you?
Yeah.
Okay. And I'm going to go to the next one.
Okay. Use worksheet 1, step 2. Yeah, I got it. Okay.
That help?
Yeah. So the allowance is 4 times the annual amount, so 4,367. Okay.
Now you're going to put in your step 3 and 4.
And so this is a good example of the 401k comes out of federal income tax, but the Section 125 deduction does not, right?
Are you referring to,
So it says 401k contributions is 6%, Section 125 contribution is 160. Oh, no, never mind.
Okay, so your withholding on this one would have been $637.85. We're going to do one more before we conclude today's session. So I'm going to let you guys take a second and fill in this one. Based on the following information, calculate the employee's federal income tax withholding for this period. Calculate federal income tax withholding using both the optional flat rate method and the 2020 percentage method.
And this time we're not using the annual table, we're using the actual semi-monthly table.
Right.
So Paytrain had us practicing both. So.
And you will have to calculate it both ways.
Okay.
Are answers coming up so far?
I got that number.
Okay. So we know with semi-monthly, it's 24 pay periods. And we know that that would be the row in which you're going to use for step 2 of the form. At least 2189, but less than 4080 is 2189 in column E.
22%.
Right?
Subtract line 2A from 1H.
And there's your tentative withholding amount. We had a dependent amount of 2,000. Divided by your 24 pay periods. And do the math.
Three. Okay.
Okay, did we all get 390.69 as the federal income tax withholding?
Yeah.
Nice. And of course, this individual also had a bonus. And you're calculating that on the optional 22% method.
$77.69. Oh.
Nice. Yes, so your total federal income tax on this particular item is $577.69. You'll definitely want to make sure that you have this process down. I know when we try to give you all these little helpful test tips, and when I took the CPP, you're talking several hundred questions, and over half of them were calculations. So you're going to be seeing numbers in your sleep. And with this new method, I know for me, this method is a little bit harder than what the way it was prior to 2000. So, or 2020, I should say. So prior to that, it was a little easier. You just found your proper tax table and you were able to come up with exactly what you needed. These seem to be a little bit more in depth, and I would want to know how to run through this worksheet frontwards and backwards. So
question on group term life.
Is
the only time that needs to be included in the calculation is if you're calculated employer taxes?
Well, no, because an employee does pay tax. on group term life because that's a benefit they are receiving. So it's increasing their income. But you know, it's so minute that you're talking, you know, you're increasing their wages by, you know, $6 or $7, sometimes up to 10 or something like that for the entire pay period.
Okay.
That is one item, and I don't know, I'm sure it's different every year, but that is one item I did not have to add in group term life into people's checks. I did have to calculate group term life, of course, but certainly didn't have to add it in plus then calculate out the net check. So, any questions? Okay, well, I took you over by a minute today, but I gave you an entire day back. We're going to give you tomorrow off, and Melissa will pick it up from here and continue on Module 7 with payroll reporting and employment taxes. Yay!
I had a question. Manon, are you making the slides?
Yes.
You are? Okay.
Yeah.
So do you know when you'll have mine made? I know mine's quite a ways out. It's not till April 7th.
Unless I'm really, really, really good,
Uh-huh.
I have it done the Friday before the Wednesday class.
Friday before the Wednesday class. Okay. So
Yeah, staying a week
basically
ahead.
I should just read the material in the book, and then I'll just review what you have.
I'll try my very hardest to get it to you sooner than that, but
No, that's okay.
Yeah,
okay.
and then you do at least have Monday and Tuesday to prep for Wednesday. You know, Thursday morning you can prep for Thursday.
Gotcha.
Yeah,
Okay.
that's at least what Melissa and I have both done.
Okay. Okay. Sounds good. Okay, perfect. Thank you guys.
No problem. Have a good weekend, everyone.
You
Yeah.
too.
Thanks for teaching us, Rebecca.
No problem. Bye.
Bye.
Bye.